Hi everyone, this is Stephen Ziff, and for those of you that don't know me, I'm a partner and co-head of investor relations at Coller Capital. I want to firstly thank you for making the time to join us today for our inaugural Barometer webinar. And on behalf of everyone at the firm, I hope that all of you, your families, and your colleagues are keeping in good health as we get through this unprecedented and uncertain time. I am joined today by one of my colleagues, Paul Lanna, an investment partner based in the US. Together, we will present the results of our latest barometer, which was published this week. We've got a lot to cover, and throughout the session, you will have the opportunity to submit questions. You can do so by using the Ask a Question button located to the left beneath the presentation window, and we will be sure to follow up with you directly after the session. For those of you that are new to our publication, Coller Capital's Global Private Equity Barometer is a unique snapshot of worldwide trends in private equity, a twice-yearly overview of the opinions and intentions of private equity investors based in North America, Europe, including the Middle East, and Asia Pacific. This edition of the Barometer captured the views of 107 private equity investors from around the world. Its findings are globally representative of the LP population by location, type of organization, total assets under management, and length of experience of private equity investing. I'd like to briefly touch on the timing of the survey. Investors were surveyed earlier this year between the 10th of February and the 27th of March. They answered these questions at a time when COVID-19 was spreading rapidly around the world. And by the end of March, there were severe restrictions in place, impacting not just our way of life, but the global economy more broadly. We have therefore excluded the results to the questions we ask each time on asset allocation, commitment plans, and performance expectations, given the significant change in outlook since that period. Our next barometer, which will be published later in the year, and hopefully once the picture is clearer, will try to give some insight on the outlook. With that introduction, let's turn to the findings. In the barometer, we track trends on a wide range of topics over time. And here you can see a big leap in the levels of LP satisfaction with the transparency of general partners. 4/5, in fact over 80% of LPs are satisfied with the transparency of the disclosures and communications by the general partners in which they have invested. This contrasts strongly with the years following the global financial crisis, when only 2/5 of limited partners were satisfied. Investors are requesting more information than ever before from their general partners, for example, by using standard reporting templates created by LPA. And now, in response to the COVID-19 pandemic, it is even more important that GPs communicate with their investors on the performance of their portfolios and just how they are mitigating the effects of the current crisis. There can be no doubt that COVID-19 has accelerated the shift from globalization to protectionism that we have been observing for a few years. There are numerous examples of geopolitical risk, ranging from the US-China trade war, Beijing's objective to impose security laws on Hong Kong, and ongoing conflict in the Middle East, to name but a few. LPs are split on the impact these tensions may have on the investment strategies and asset allocation decisions of private equity and venture capital funds in the next 5 years, with half of the world's investors believing there will be a material impact. Interestingly, this 50-50 split in limited partners' views is the same across all regions. There is a much clearer divide, however, on the outlook for emerging private equity markets, with many investors predicting an increase in political risks. Nearly half of limited partners believe political risk in private equity's emerging markets is increasing, and only 5% think it is decreasing. On the right-hand side of the page, you will see that around 2/3 of LPs think the emerging private equity markets of Russia, China, and the Middle East and North Africa will show a higher than normal level of political risk in the next 5 years. By contrast, only just over 1/3 of LPs expect heightened political risk in India or Central and Eastern Europe. Investors see the least political risk and are therefore most positive about Southeast Asia. Only just over 1/4 of private equity investors expect political risk in the region to increase over the coming years. In our barometer last winter, we asked about the attractiveness of these markets. At that time, Southeast Asia was viewed as the most attractive market for private equity investment, followed by China and Hong Kong. The results this time certainly show a shift in the outlook for China when compared to Southeast Asia. Let's now turn to another topic, concentration within the private equity industry. Whilst total private equity fundraising in 2019 remained robust, the number of funds dropped significantly and mega funds reached record levels, with increased levels of capital concentration amongst the most established managers. Against this backdrop, we asked investors for their views on concentration levels over the coming 5 years. Almost 3/4 of limited partners expect assets under management in the private equity industry to become more concentrated, with the largest general partners raising a growing proportion of total private equity commitments. Only 5% of investors expect large GPs' share of commitments to diminish. Despite this outlook on concentration, LPs are, on balance, planning to increase the number of relationships they have with general partners. The chart on the left shows the change in this trend from the last time we canvassed opinions on this topic. That was back in the winter of 2012-2013. At that time, equal numbers of limited partners were planning to increase and reduce their overall number of GP relationships. There was a trend amongst large investors, for example, to reduce the number of relationships with general partners, and over time we have seen these investors invest more directly in private equity as a way of reducing their fees. However, with access to funds now becoming increasingly competitive, some LPs are having to cast a wider net in terms of the number of relationships they have with general partners. Almost all government-owned organizations and sovereign wealth funds expect to increase the number of general partners with whom they have relationships in the coming 2 to 3 years. While the most mature of these funds are taking the direct route, that is, those that have been investing in private equity over the long term and have large, sophisticated programs, a growing number of institutions around the world are still at the very early stages of expanding their programs in private equity. Half of insurance companies plan to increase their overall number of GP relationships as these institutions continue to search for yield. At the other end of the spectrum, the maturity of some corporate pension plans sees these institutions more likely, on balance, to be decreasing the number of their relationships. Another change that is happening and is likely to have a significant impact in the future is the opening up of the private equity markets to retail investors. This month, we saw an announcement from the US Department of Labor that 401k plans, in effect employee retirement plans, were eligible to access private equity funds. The defined contribution pension market is worth roughly $7 trillion, suggesting the market opportunity in these 401k plans could reach hundreds of billions of dollars. It is likely that private equity investing will be through structures that create diversified portfolios. Valuation has been a long-term obstacle that has prevented this market from opening up to private equity. One solution is that the plan fiduciary could require the investments to be independently valued in order to meet the plan's regulatory obligations. And it seems that institutional investors are already heading in this direction. 1 in 5 investors currently require their general partners to use third parties to provide independent portfolio valuations, and this proportion is likely to rise to almost half of LPs in the future. COVID-19 is only likely to accelerate this trend. Given the added complexity, several private equity firms have turned to accounting or valuation consultants for an independent view on their valuations. And with that finding now coming to an end, it's my pleasure to hand over to Paul to talk through the rest of the barometer.
Thanks, Stephen, and hello everyone. It's my pleasure to present the remainder of our findings. Let's start with the role of the Limited Partners Advisory Committee, or LPAC. An organized and engaged LPAC is a benefit to both GPs, as it helps to strengthen the relationships outside of the fundraising cycle, and LPs, as they gain access to deal teams and the people responsible for fund operations. LPACs are often weighted towards the largest LPs in the fund, or those with long-standing relationships with the GP. So there can be conflicts for individual LPAC members when it comes to co-investments and cross-fund investments. The role of the LPAC is to advise the GP on issues such as conflicts of interest or material changes to fund strategy. And as the number of LPAC seats for a fund have increased, it's also become a sounding board for GPs. Here's a snapshot for how LPs view LPACs. A large majority of LPs sit on at least one advisory committee. Most LPs hold LPAC seats for only a small proportion of their PE funds. But 1/4 of LPs, especially large investors, hold LPAC seats for more than half of the funds in which they are invested. On balance, most LPs believe LPAC seats are allocated appropriately by GPs. However, LP views vary considerably by region. While almost 3/4 of European LPs believe LPAC seats are allocated fairly, only half of LPs in the Asia-Pacific region share this view. Most interesting are LPs' views on representation and performance of LPACs. 2/3 of LPs believe that advisory committees do not, in practice, provide equal representation for all investors in the fund. And this view is shared by investors who sit on many LPACs. Nevertheless, over 3/4 of LPs think advisory committees generally do a good job. And this picture holds true, even for those with concerns about the composition and equal representation of LPACs. This is a positive finding for the relationship between LPs and GPs. And focusing further on the relationship between investors, we asked LPs for their views on interaction between LPs. 3/4 of limited partners told us they would benefit from more opportunities to interact directly with other private equity investors. But these extra interactions that LPs would value differ by region. Investors from North America and Asia Pacific would most like to know more LPs from elsewhere in the world, whereas European LPs would most like to interact with limited partners from organizations similar to their own, and with LPs invested in the same funds. For North America, this could be due to certain types of investors being unable to travel, like public pensions, even before the coronavirus pandemic. In Asia, the relatively immature private equity market, when compared to North America and Europe, is a reason for Asian LPs to want to establish relationships with investors in more developed markets. With many restrictions on international travel and large gatherings in place due to COVID-19, it seems the opportunities for investors to meet other LPs from outside the region will mainly take place in the virtual world for the time being. Which brings us to our next topic of climate change. While most LPs report a broad consensus of agreement within their organizations on ESG policy, especially among European LPs, their views on climate change are more varied. There is far less consensus about climate change within LP organizations based in North America and the Asia-Pacific region than in Europe. Adopting a formal ESG policy has been a long-standing goal for many organizations worldwide, and private equity has led the way by putting good governance at the heart of investments. Developing a consensus on climate change appears to be more of a challenge, and one way to understand this is by looking at how LPs view carbon neutrality. The Intergovernmental Panel on Climate Change has stated that the world must cut emissions to net zero by 2050 if we are to alleviate the climate crisis that is impacting our world. Although only a tiny proportion of European limited partners are currently carbon neutral, well over half of them expect to be by 2030. In contrast, the majority of North American and Asia-Pacific LPs do not expect their organizations to seek carbon neutrality at any time in the foreseeable future. And although there appears to be more work to do at their organizations, many LPs think GPs are not taking the risks of climate change seriously enough in their investment policies and practices, with over 3/4 of Asia-Pacific LPs holding this view. LP scrutiny on their GP's approach to the issue is intensifying. Managers can expect to receive more and more sophisticated questions on climate change. One challenge is that many GPs do not collect enough data to sufficiently respond to their LPs. With so much uncertainty in the world and the long-term economic and social impact of the COVID-19 pandemic still unknown, I'd like to finish by looking at the topic of disruption. Many industries are facing a severe disruption, and they are having to adapt their own business models to reflect the new normal. Many of these industries are backed by private equity. It is therefore positive to see that investors believe that private equity is a source of creative disruption in the economy and can act as a catalyst for a wider change in areas where it invests. This is a subject we recently focused on in one of our academic publications, Private Equity Findings, which is produced in collaboration with Josh Lerner of Harvard Business School. As private equity has grown in stature, so has its sphere of influence. The article in PE Findings is called Unforeseen Consequences. It's an interview with the authors of 3 academic studies, and it looks at the indirect impact of private equity investments on competitors, on public markets, and sector productivity. The findings are then discussed with 2 seasoned fund managers. It's well worth a read. The notion that private equity is a catalyst for change is supported by LP's views that the expertise required to run a buy and build strategy is no longer the domain of specialist GPs. This strategy became popular recently as it's offered a path to value when multiples were at record high levels and PE firms faced competition in a booming market. In 2019, add-ons accounted for 68% of all U.S. PE buyouts. 2/3 of LPs tell us they believe that buy and build skills are now part of the toolbox of many private equity managers. LPs are also clear on the role of operating partners within a private equity firm. This was the fastest growing position in private equity in 2019. An operating partner can add value when a portfolio company needs to evolve to support the next stage of growth. And the role is becoming more specialized around industries or functional areas within portfolio companies. GPs are communicating well with LPs regarding how and why operating partners are deployed, and the value that an operating partner adds is now clear to the majority of LPs. That concludes our findings. To summarize, in this barometer, investors are telling us they are satisfied with the levels of GP transparency, they foresee increasing political risk in private equity's emerging markets, they expect private equity commitments to become more concentrated, and they view private equity as a source of creative disruption. We will circulate a downloadable version of this presentation by email tomorrow, or alternatively reach out to any of the Coller team and we will arrange to send you a copy. The Barometer and Private Equity Findings are both publications of the Coller Research Institute. You can find more information about these reports and our other work on the research section of the Coller Capital website. There is also an option to subscribe to our research for future publications. That concludes our presentation. For those of you that have submitted questions, we will follow up shortly. Thank you very much for listening.